Hi everyone, this is Mike Maloney, and my last video was about the collision course that the Federal Reserve is doing with raising interest rates versus the economy versus all of the bubbles that they have created. And they are on this collision path. There is a way, I believe, of avoiding the train wreck, and I'll get to that way later on. But this could be an absolute disaster in the making. Now, my last video, I was hoping it would do really well, but during the premiere, which has a big effect on what the video ultimately does, there were these areas that where the video buffered, and each time it would buffer, we lost a huge percentage of the audience. So the video did very poorly, which was incredibly disappointing for me. These videos where I'm doing a keynote presentation take a lot of preparation time, and I had a lot of work in this video. So anyway, I'm going to recap the last video just real quickly here. One of the things that was most concerning to me is the rate of change of the federal funds rate, how quickly they're increasing the interest rates. And this chart, when I did that video, it was basically a message to the Fed to be, in their meeting the following day, to really reflect on the speed and the bubbles that they have created and how they could break this whole economy. Now, a lot of people are writing down in the comments that this is part of the plan, that this is on purpose. Maybe it is, because they seem to be incredibly reckless and just moving forward with things regardless of what the consequences might be. So this chart is from last week, and since then they've changed the Fed funds rate, and it's gone up from about 4,300% to about 5,300%. Year over year increase. There's nothing like this that has ever happened in history. And it looks as though they are determined to just slam this thing forward as fast as possible, acting really bold and courageous like they are Paul Volcker. But this is a different environment than the chairman of the Fed back in the early 80s. He was from 79 to 87. Paul Volcker was the Fed chairman. So this is the rate of the 3-month Treasury bill increase. Now the rate of change at 8,300%. And what scared me here is that this is the plumbing of the financial system. This is used about as often as cash in the transactions that are happening between banks and stuff. This is the plumbing, and the cost of this plumbing and how much the bill is paying and stuff, depending on who is holding it as collateral and who loaned it as collateral. That depends on who is getting this interest, what the cost is. This rate of change isn't something that the financial system can adapt to quickly. I covered the spread between the price inflation, consumer price index inflation, and the Fed funds rate, and I showed that typically throughout most of its history up until this century, the Fed funds rate is usually above the rate of inflation, significantly above. And the few times that it wasn't, there wasn't really any inflation from this event here through the 60s. Very low inflation. And the Fed funds rate stayed above the inflation rate through the 60s. And then in the 70s, inflation climbed above the Fed funds rate here, and a little bit there, and a little bit here, and then a lot there. But it was pretty much right on the Fed funds rate, and that led to some serious inflation, but it wasn't as much this as the year-over-year inflation of the currency supply that was increasing, and then all of this currency we had created for Korea and Vietnam, and then Johnson's Great Society coming back to haunt us. Paul Volcker slammed them up to where they were sometimes 3 times the rate. The rates were 3 times the rate of inflation, but typically about twice the rate of inflation, all the way until the end of this century. This is Alan Greenspan here. And then this whole century, with the exception of this little thing here, the Greenspan goof, and Janet's jam. This is the spread that I was talking about. Greenspan goof, Bernanke blender, Janet's jam. And this is the Powell predicament right now. But look at where Paul Volcker was doing this, and look at how the rates came down very quickly as the currency supply slowed in growth. That is the main thing here, is slowing the growth of the currency supply. Not getting, one of the reasons they want to get the rate of the Fed funds rate above the rate of inflation is to slow the number of loans that are being made. When interest rates are higher, there are fewer loans. And so that will slow the growth of the currency supply. But with bubbles the size that we've got, so what that led to, so this is that area. Oh, do you think that any of this inflation could have come from a 40% increase in the currency supply? This is the M2 currency supply. But we've got this area here is that area where Paul Volcker took over and was raising interest rates way above the rate of inflation from 1980 to 1987. It bottomed right about here. Alan Greenspan took over and raised rates, but you'll see that there is a time lag. Notice that this goes flat in about 1995, and it was slowing in from 89, 88 until about 92. And here is, by the way, later in this video, this is going to be important. The M2 is contracting now. It doesn't do that very often. There's a little tiny wrinkle right here. But on the whole, this is an extremely rare event that we are experiencing right now, a contracting currency supply. It's going to be very important later on. So this is the growth of the M2 currency supply, percent change year over year. So here, it was growing in the 70s at like 14% year over year. But during that period of time when Paul Volcker took over, the rate of growth, and I want to point out here that the Federal Reserve does not have direct control over the currency supply that we use, the M2 currency supply. The bank reserves are not a part of this. They have control over bank reserves, over interest rates, over things like that. They influence how much currency the banks create for us. And by raising rates the way he did, he got this to fall. But then he lowered rates over the rate of inflation fairly quickly because this was falling so quickly. And we did experience a recession in 92. So Alan Greenspan continued pulling the rates down so that it would create more loans. But there is that time lag that I pointed out. This bottoms in 85. This bottoms in 1995. Anyway, so what we have here is the percent change in the rate of the growth of the M2 currency supply year over year. And you can see that it has fallen dramatically. I mean, it was huge. This is where the inflation came from. It wasn't Putin. It wasn't the supply chain issues. That triggered the release of all of this stored energy, of all of the currency they created. But mostly the inflation came from this growth of the currency supply. And now we've got it down at rates at 5% or below here, year over year growth. So this is a good trend. I just want to point out deposits. This is where the inflation came from. People are sitting on all of this currency, and the prices have to try to rise to strike an equilibrium between the size of all the amount of goods and services in the society that you can buy and the currency you can buy them with. Now, I did cover the size of the bubbles that we are coming off of, measured by PE ratios, the second largest stock market bubble in history, 1929, the tech.com boom. This is the second largest bubble. And we are deflating off of that bubble. The bubble hasn't burst. We haven't experienced a violent crash yet. But by other measures, how many work hours it requires for somebody that's on like a blue collar or a paycheck type of job, the number of hours you have to work to equal the points on the S&P 500 has never exceeded 40 until the late 1990s. And so the fair value is when it's about 20 hours of work equals the points on the 22 hours, something like that, maybe 25 at the most. And here we are up at 125. Same goes for the Buffett indicator, probably the best measurement, the size of the stock market's value compared to the GDP of the country. And the companies that make up the GDP have no business being valued higher than the GDP. We've been insane this whole century. We dropped down to what is about fair value of 60 or so, 65, during the crash of '08. But we're in a bubble where it says the stock market needs to fall by half to get back down to bubble territory, because this is where you're reaching a bubble, 100%. So it has to crash even further than that, much further, to get back down to fair value as far as the Buffett indicator. Real estate, this is the home price index. It's not the real home price index. So this is not adjusted for inflation, but it is indexed to 100 in the year 2000. And here we are up at about 300. And so we're a couple hundred. Prices have basically tripled since the year 2000 is what this is saying, but it has rolled over and so far is deflating. We don't have a bubble bursting yet. This is the rate that they are deflating at, though, and that is too fast. The Fed, if they want to bring us in for a soft landing, needs to slow this down. This is real home prices, so now this is adjusted for inflation. So this is showing how overpriced they are in terms of value of the home compared to the rest of the economy. And what you see here, this is indexed back to 1886 when the data starts. It really probably should. This is probably the fair value right about here. So they'd need to raise this by 10 or 15. So instead of being 125% overvalued, it would be like 105% overvalued, but still, it means that real estate needs to drop by 50% to get back to these historic norms of fair value. Now, I also showed the number of zombie companies where they can't afford to pay the interest on their debt out of current cash flow, and it's currently 1 in 5. Now, here's a chart I didn't show you. This is corporate debt as a percentage of GDP. And I want to point out, that it goes up and we have these really bad recessions and crashes. So this is 1990, this is 2000, this is the recession of 2001 and 2008. And I'm going to read you a little bit from my book here, because this chart comes from my book that will be coming out. It reached 43% in 1990, and the following recession caused what UPI News called the bloodiest year in the history of the U.S. automotive industry. America's big three, General Motors, Ford, Chrysler, suffered losses of more than $11.5 billion, and General Motors closed 21 plants and laid off 74,000 workers. But it was far more than just the auto industry. Pan Am, Midway, and Eastern Airlines all filed for bankruptcy. So that's this one. The next one here. In 2001-2002, it reached 45%, and WorldCom became the largest bankruptcy to that date, followed closely by Enron, Conseco, Pacific Gas and Electric, and Global Crossing. In 2008, it reached 45% once again, and shortly thereafter, Lehman Brothers failed in the largest bankruptcy in history, almost 7 times larger than WorldCom, followed by Washington Mutual, almost 3 times larger than WorldCom, followed by the bankruptcies and bailouts of General Motors and Chrysler. And so look at where we are today, up at 50%. If they break something, it's going to be horrific this time. And so, getting back to zombie companies, they are raising rates, which means rolling over old debt into new debt becomes more expensive. We are already creating zombie companies. The economy isn't growing as rapidly as it was a year ago. Corporate profits are going to be down compared to what they were. And now the cost of rolling over that debt is going up. So this chart that I made that goes up to the middle of 22, this is already rising. So the next chart is something very interesting that I found on the Fed's website. They break down the CPI into flexible prices and sticky prices. Flexible prices rise and fall very quickly. And so as soon as inflation starts, they take off like a rocket. Sticky prices take a while. Flexible prices also come down very quickly. Sticky prices take a while. So it depends on the goods that they are measuring. And the Federal Reserve has taken this basket of goods and separated them into two: fast inflation and slow inflation. And so what's interesting, if you take a look at this peak here, up at about 17% year over year price inflation for these flexible items that are fast, that corresponds to this sticky price inflation of way down here. And then these items in the sticky basket started rising. Notice also how high sticky prices were back in the 70s, but then how low they were in the 70s. But what I find hopeful about this chart is how quickly all of these prices in the flexible price index are falling. And that means that sticky prices will probably rise for a little while and then start to fall. So they're already down at like 6% and they're still falling. So what will probably happen is something like this. And what the Fed really needs to do, they are in a box. The only way that I can see out of that box is by allowing inflation to run at 5 or 6% for several years. It's hard for businesses to manage, but it's not impossible. It's not like the 70s where you just can't predict anything and you've got to raise your prices every month or every 2 months. It's just absolutely insane. And here is they need to start looking at history. What does history tell us? Well, we've seen the bubbles that the stock market and real estate is in. When have we ever seen a soft landing? Nobody even pays any attention to what a soft landing is because we don't have any examples in recent history. But if you look back a little ways, this is from 1949 to today. It's the Dow Jones Industrial Average, so it's a proxy for the stock market. And you'll see that in the middle of this chart here, it hit 60 in 1966. The Dow bumped its head on 1,000 points and it couldn't break through until 1982. So you're talking about 16 years of sideways movement here, while the economy was still growing. So it was able to catch up with the stock market. When you inflation adjust this graph, it looks like this. And what you see is that even though the stock market did not crash, there was a 70% crash in the value of the stock market. The reason this chart looks like this is because during that 16 years, the economy was allowed to catch up with the bubble that the stock market was in. That is the way out for the Fed. So getting back to the PE ratios here, here's the bubble in 1966 of PE ratios of about 23, 24, and then they fell all the way to 7 while the stock market was going sideways. No crash, soft landing. This is the work hours. And you see from 39 hours down to about 19 hours, while the stock market didn't crash. It was the economy growing to match the stock market, to get up to the same levels. Same thing with the Buffett indicator. And then we've got the reason that we are in a predicament this time, this is current government receipts, so how much the government takes in. This is their expenditures. It's a few $1 trillion higher than the receipts. Notice, these are the recession bars. Notice those two big dips that they start just before the recession, the recession caused by the crash of the NASDAQ, the dot-com tech bubble, and 9/11, and then just before the global financial crisis of 2008. And there's significant reductions in the government revenues. But look at the spending. It never stops. There's back in 2011 or 12, there's a tiny little pullback in government spending, but typically government spending continues on up even during these pullbacks in revenues, which makes the deficits explode. And so here is the deficit, and you can see what happened because of this recession, the fall in revenues, but the spending continues increasing. The fall in revenues and the spending continues increasing. And look at what we have done lately. This is just totally insane, and we haven't even started the next recession. When the next recession really comes home to roost, this is going to be something horrific, because the revenues that the government is taking in are going to fall. And we just passed the Inflation Reduction Act, which adds another $750 billion to this. And so I just can't believe that the people running things are allowed to continue running things. By the way, this is when we left gold. It is what has allowed all of this. Now, this is the gross federal debt to the GDP of the country. And you can see that when Paul Volcker was raising interest rates, it was down below 50% of GDP, and now we're up over 120%. How do they figure they can pull this off without crashing not just the U.S. economy, but the entire United States of America? I mean, the government is in some serious trouble here. This is the total public debt, total federal debt. It's approaching $32 trillion. By the time the debt rolls over every 4.5 years roughly. And so by the time these rate increases start affecting the interest on the national debt, this will be 36 trillion. Right now, inflation is running 8%. Paul Volcker had to take it to double, take the Fed funds rate to double that. So if they really did a Paul Volcker and they took interest rates to 16%, calculate the interest on $36 trillion of national debt at 16% interest. And I think you're going to find that it exceeds the entire income. And so everything becomes deficit spending, and that is just a road to hyperinflation. So what the Fed has to watch out for is that 1 in a million event that could happen, that black swan, and then they will be only focused on that black swan, and it'll be too late because they will have already taken the economy off the tracks. It will have been derailed, and the pileup, the wreckage that will ensue is going to be tremendous. And trying to clean this up will take years, if not decades. I want to thank you for watching. We'll see you next time.